I'm going to talk about one of my favorite microcap stocks in the market. Before we dive in, please take a minute and click subscribe to my channel if you don't already. And check out the link you see on your screen. You can get the top 10 stocks to buy right now from the Motley Fool. They're my sponsor, and it's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. Check it out. So the company I'm talking about is Nextdoor. And I know some commenters asked me to stop talking about it so much because I did a couple videos on it earlier. And I said I would stop until earnings, and now we got the recent earnings, and the results are pretty strong. So I'm going to make another one. So we're going to talk about Nextdoor today. Let me go ahead and share my screen. A lot of people know Nextdoor because they are users of the platform, social media company that's pretty popular. They're neighborhood-based social media. So here are just kind of the headline results from the quarter. You can see revenue is up. You can see the acceleration here, first of all. This is one thing I want to point out. Revenue is accelerating quarter after quarter after quarter ever since their CEO and, their founder, Nirav Tolia, came back to the company about a year ago, focused on efficiency and kind of figuring out ways to grow the business. And it looks like it's working. 17% year-over-year revenue growth in the third quarter. The fourth quarter is historically the strongest for social media companies. In simple terms, companies spend more on advertising in the holiday season. So I'll be curious to see if that acceleration continues, or even another quarter of 17% year-over-year growth would be pretty nice. But 17% year-over-year revenue growth. Weekly active users are up 13% year-over-year to almost 46 million. That's a pretty impressive growth rate, especially when you look at some other social media companies. On a net income basis, they're still losing money, although that loss is much narrower than it was a year ago, less than half. And on an adjusted basis, Nextdoor is actually on the verge of profitability. I wouldn't have thought that, in the third quarter of 2024, especially last year as an investor, when on an adjusted basis, they were even losing $20 million a quarter. But now they've really done a great job of efficiency, and I'm going to go through some of those numbers in just a second, but wanted to go through this first. So if I go through some of the key highlights of the quarter. So the ad platform is obviously the biggest part of the business and the big driver of growth. It's delivering a lot better results for advertisers. Nextdoor's done a great job of incorporating AI into it to kind of create more optimized campaigns. It's delivering better results for advertisers, which creates a more attractive product and brings more companies into the Nextdoor ecosystem as customers. We're seeing higher click-through rates, just a very impressive performance from the ad business. And still, monetization for Nextdoor is a fraction of what other social media companies have. So it could get a lot better from here. Efficiency, I mentioned, has been the big focus over the past year or so. Essentially, Nextdoor was hemorrhaging money up till about a year ago, but margins are improving fast. Lower personnel costs. Their scaling efficiency is impressive. And just look at that last statistic. The revenue per employee is up more than 60% from this time last year. That is a stellar improvement in efficiency and explains why it's becoming so profitable, or becoming close to profitable so quickly. Another thing they've really done a great job of getting under control is stock-based compensation. I am not a fan of companies who pay a lot of stock-based compensation. It was probably my biggest negative of Nextdoor in the beginning. When they first went public was, as I mentioned, during the big SPAC boom. And at the time, the stock-based compensation didn't represent an unusual percentage of the total company's valuation, so it wasn't that big of a deal. But now that the SPAC boom ended, Nextdoor stock crashed down to earth. It's trading for roughly 1/4 of it was of the price when it went public. And now it's a lot. I still think Nextdoor stock-based compensation, this is probably my biggest negative on the company as an investor, is way too high for a business of this size. Again, about a $1 billion market cap and $54 million in stock-based compensation through just the first 3 quarters. Now, to be fair, progress is being made. This is part of the efficiency improvements and better capital allocation. Stock-based comp is down 11% year over year. still is way too high. The company is buying back stock hand over fist, and the outstanding share count is not dropping as much as it should. And this is why it's kind of a dilutive practice. But a lot of tech companies do this because it doesn't show up as an actual cash expense on the cash flow statement. So Nextdoor has a great balance sheet. That's another big highlight from the earnings report that I wanted to get to. They have about $425 million in cash and equivalents like short-term investments, and they have no debt whatsoever. They have a very, very strong balance sheet. Again, that's $425 million in cash from a company that has a total market cap of about $1 billion. With some of that extra capital, while the stock is cheap, they're spending a lot of money on buybacks. They spent $21 million roughly on buybacks in the third quarter alone. There is $100 million left on the buyback authorization. Now, that is more than enough to offset the stock-based comp that I mentioned in the last slide, but not by a ton. So the buybacks will be a lot more meaningful the more they can get that stock-based comp under control. But even with that, the diluted share count is down by more than 5% this year. So they are making a dent in the overall share count and using capital in that way in a responsible manner. So I like that. And one thing that is really worth pointing out is that the best could be yet to come. I mentioned their founder came back into the fold earlier this year and really started implementing some product adjustments. But the thing that efficiency is what you can see in the numbers so far. The product adjustments are not reflected in the numbers so far. That's why you're not seeing, average revenue per user really spike. It isn't. I'll spoiler alert. We're not seeing big growth in monetization yet. But so this quote from the quarterly shareholder letter. Our timeline is unchanged, and we do not expect to see meaningful signs of product-related progress until mid-2025. So sometime in the middle of next year, you should start seeing some of the results of what Nextdoor is doing behind the scenes with its products. All the the improvements to the ad platform and things like that, and the improvements to the way that posts are generated on somebody's timeline and things like that. You're not going to see that reflected in the numbers just yet, but it is coming. The timeline is unchanged according to the founder and CEO. So Nextdoor's quarter looks really, really strong. I'd love to know what you think. If you still want me to stop talking about Nextdoor, let me know in the comments. And if you have any other questions or comments about the company, please leave them for me there. I'll do my best to respond to any of them individually. Again, please click subscribe to my channel, and thank you for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.